Welcome to Byte-Sized Tech. Right now, the entire tech world is playing an absolutely massive, high-stakes poker game. We're talking trillions, with a T, being shoved onto the table, all for artificial intelligence. And that brings us to the central question of this explainer. Are we watching a truly historic breakthrough unfold? Or is this just the biggest, most spectacular bubble we've ever seen? So to really set the stage, let's start with this pretty stark warning from a big-time investor, David Einhorn. He's not just, being cautious here. He's sounding a serious alarm. He's looking at all this massive spending on AI infrastructure and is basically predicting that huge amounts of that money are just going to be lost. It's a really sobering thought that kind of hangs over this entire boom. But just how big are we talking here? Well, the numbers are just staggering. By 2030, some analysts are estimating that building out all the data center capacity needed to power this AI revolution could cost upwards of $2 trillion. I mean, that is an unprecedented amount of spending that makes previous tech cycles look tiny. So you have to ask, where is all this cash coming from, and is this bet actually going to pay off? And that leads us to the trillion-dollar question that is Wall Street and Silicon Valley completely split down the middle. You've got the bears on one side who see a total disaster just waiting to happen. And then you've got the bulls who are convinced this is just the start of a fundamental change to our entire economy. And you can really see the two sides of the coin here. The bears are terrified that companies are writing checks they just can't cash, and they keep pointing back to the dot-com bubble. They're worried about something called counterparty risk, which we'll get to in a sec. But the bulls, they're saying, no, this is totally different. The spending is being funded by real cash from huge profitable companies. It's going into real tangible infrastructure. And honestly, supply still can't keep up with demand. They see a solid foundation, not a house of cards. So let's quickly unpack that term, because it is right at the heart of this whole bubble debate. Counterparty risk is just the fancy way of saying there's a risk that the other guy in your deal just can't pay you. So imagine you're spending billions to build a data center because a company promised to pay you for it. What happens if that promise and that money just disappears? And here is where that risk gets very, very real. And the numbers become absolutely jaw-dropping. OpenAI has reportedly committed to paying Oracle a mind-boggling $300 billion for cloud services. The thing is, OpenAI is still losing money. So if you're Oracle, you gotta be wondering, where is that $300 billion actually gonna come from? This is exactly the kind of risk that would keep me up at night. Okay, so with trillions of dollars on the line, how does the industry even begin to protect itself from this? Well, that brings us to a really fascinating potential solution. What if you could just turn compute power itself into a commodity? Seriously, how do you hedge your bets when your entire business plan hangs on a multi-billion-dollar promise from someone else? You absolutely need a way to create some kind of financial safety net. But how on earth do you do that for something as brand new and, as intangible as AI compute power? Well, the idea being floated is pretty radical, but also kind of brilliant. What if you could trade AI compute power just like you trade barrels of oil or gold or shares of a stock? Picture it, a big open exchange where supply and demand could meet in real time to set a fair price for processing power. This could solve a ton of problems. But how would that even work, right? I mean, compute isn't simple. It has hundreds of variables. What kind of chips are you using? What's the guaranteed uptime? What time of day is it? Well, the solution is to use an auction that's actually powered by AI itself. A super sophisticated system, what some people call a combinatorial auction, could juggle all these complex bids and offers at the same time. And out of that, you'd get a true market price, letting companies lock in their costs, sell off their extra capacity, and finally, hedge against that massive counterparty risk. And this whole problem of managing huge multi-billion-dollar commitments, it's not just a theory. It is playing out in the real world, right now, in a super high-stakes deal with massive geopolitical implications. And yeah, I am talking about the whole saga with TikTok's US operations. Okay, so the proposed deal to create a so-called TikTok America is just incredibly complicated. You've got American investors like Oracle and Silver Lake, but also MGX, which is a state-backed investment firm from the UAE. But the really wild part is that, according to the reports, the Chinese parent company, ByteDance, would still get more than half of the profits. Now, that structure raises a lot of questions, not just for politicians, but for the people who actually pay the bills. And that gets us to the business reality of it all. As McMac's CEO says here, the advertisers, the ones spending billions on the platform, are pretty much just holding their breath. They're in wait-and-see mode. And even though traffic on TikTok is at an all-time high, they know that creating a separate American company could just change everything overnight. So, what exactly are they worried about? Well, it all comes down to results. Are users going to stick around? Will their ads keep working as well as they do now? And for a big global brand, this is a huge one. Are they now going to have to log into two completely different platforms to manage their campaigns? These are really basic questions. And if the answers aren't good, you can bet those ad dollars are going to fly over to competitors like Meta and Google fast.
But beyond all the business stuff, there's a cultural question, right? The actual magic of TikTok is its algorithm, that spooky ability it has to know what you want to watch before you even know it yourself. The creators and the users, they don't care about the ownership structure, they care about the vibe. So maybe the biggest question of all is, if you split the US algorithm from its global brain, does TikTok just stop being cool?
And this is the giant technical problem they have to solve. The plan is to create a digital twin of the master algorithm. But this new version, it would only be trained on US data, completely cut off from that global feedback loop that learns from billions of users around the world. It's kind of like trying to recreate a genius, but only letting them read books from a single library. It is a huge, huge gamble, and if the transition is bumpy, it could permanently wreck the user experience. So whether we're talking about the AI boom or the TikTok deal, it's clear the stories we tell about them are incredibly powerful. And that brings us to a really interesting trend, the rise of a whole new kind of power broker who shapes those stories directly, the analyst as influencer. I mean, look at this. Analysts like Tom Lee and Dan Ives have built up these huge followings on social media. This gives them a direct megaphone to everyday investors, letting them totally bypass traditional financial news. They have become major brands all by themselves. And now they're taking the next logical step. Instead of just talking about their ideas, they're actually packaging them up into a product by launching their own ETFs, or exchange-traded funds. This lets their followers invest in their entire worldview with a single click. It's a brilliant move to cash in on their influence, but it also raises some tricky questions when an analyst's commentary can directly drive money into their own fund. So, what do we have? Trillions in capital flowing around, massive geopolitical deals hanging by a thread, and powerful new voices shaping the market. It really does feel like a new gold rush. But that brings us to our final question. Who's actually getting rich? Ultimately, we are in a new kind of gold rush, one that's fueled by a wild mix of real innovation, incredible hype, and just an insane amount of capital. But when the dust finally settles, who are the real winners going to be? Is it the engineers and innovators who are actually building this stuff? Or is it the investors, the deal makers, and the influencers who are placing the bets and shaping the stories? That tension really defines this moment in tech. So who do you think the ultimate winners will be? Let us know what you think down in the comments. And if you enjoyed this episode, please like, comment, share, and subscribe.